We are co-lending a new era of collaborative financing. Welcome back. Now let's talk about a game changer in the lending ecosystem, co-lending. This panel will dive into how traditional lenders and fintech firms are joining forces to create smarter, more inclusive financial solutions. Moderating this exciting discussion, we have Mr. Rahul Jain, co-founder All Cloud, and joining him are industry leaders. Can I have a huge round of applause for Mr. Rahul Jain? Followed by Mr. Rohit Mehta, MD, Akasa Finance. I think he'll be joining later. Mr. Sanjay, Shamnani, Head Treasury and Co-Lending, Kissht. Please, can I have the applause? Mr. Brajesh, Pranami, founder, Fly High Finance. And please join me in welcoming Mr. Atul Monga, founder, Basic Home Loan. Please, a huge round of applause for him as well. And at last we have Ms. Vasudha Goel, Head Internal Audit, Satya Microcapital. A huge round of applause for her as well.
Right, good afternoon, everyone. Excited to host this panel. I've got a fantastic panel on either sides from industry leaders who've done a lot of work in the lending industry and especially in co-lending as well. Co-lending in India has seen two cycles, with the regulations laid down in 2018 and revised again by the RBI in 2020. A couple of loans, products have seen two cycles if I look at the short term, but then we also have long-term loans which is just in about 6-7 years. Co-lending is definitely an evolving concept, and I think from a strategy perspective, it is one of the most important areas for any NBFC or a bank because it's a partnership and it opens up new avenues for both the partners, the bank and the NBFC, or I would say the operating partner and the lending partner in this case. So we'll take on the session. We've planned to bring more insights with real-time experience of the panelists here, and want to relate not to a very academic discussion on co-lending, but the real scenarios, issues, and outlook for co-lending in the future. With this, I'd like to introduce myself. I am Rahul Jain. I'm co-founder of All Cloud. We are a lending technology company. We've been in the industry for the last 10 years, work with about 100 plus lenders in the country today. We provide a unified stack for lending, LOS, LMS collections, and co-lending. Happy and excited to host this session. I'd like my panelists to please introduce, and then we'll start with the conversation.
Thanks, Rahul, for such a nice setup on the co-lending piece. Just starting with the introduction, myself, Sanjay Shamnani. I am graduate. I'm Ahmedabad graduate and the chartered accountant too. I'm a founding member of Kissht. Been in Kissht for 8 odd years. My initial journey started with Kissht with respect to the more of the finance domain with respect to the fundraise on the equity piece. Slowly, gradually, it deepened into the treasury piece with respect to the fundraise on the credit side. And then thirdly, the way we have evolved, we have started partnering with various banks and NBFCs on the co-lending piece. So been in Kissht for 8 odd years, seen the baby grown from 4 odd crores of AUM till now 3,600 crores AUM. So heads off to all partners supporting us and backing us very largely.
Wonderful. Thank you, Rahul. Wonderful introduction, Sanjay. My name is Brajesh Pranami, and I'm the founder and CEO at Fly High Finance. We basically are an NBFC highly focused on domestic education loans. I've spent close to 25 years in Indian BFSI. Worked with large MNCs as well as Indian banks and NBFCs, including GE Capital, Stan, HDFC, etc. Being an entrepreneur for the last 5 years, and this is my third startup company. I've successfully exited a couple of startups. Very, very excited to be a part of this wonderful topic and being with the other esteemed panelists. Look forward to have a great learning around.
Hi, I'm Atul and I'm founder of Basic Home Loan. Basic is basically we started it as a broker, but we evolved into more risk-sharing relationship with lenders in form of BC workflows or FLTG relationships. We are in process of setting our co-lending lines also. So hopefully we'll be able to provide some insights on the things we have seen in the past while during our journey.
Good afternoon, everyone. I am Vasudha. I head internal audit for Satya Microcapital. It's a Delhi-based NBFC MFI. We have presence across the country with our primary business into Bihar and both Eastern and Western UP. We are in this business since 2016. Welcome you all.
Thank you. Like I said, panel is full house. We've got somebody who's heading Treasury for a large NBFC. We've got Brajesh who's into education loans, and I think they're taking the journey to co-lending as with fintech, basic loan, and Vasudha from Satya. So, stay tuned for some great insights on co-lending. And since Brajesh just mentioned that you've been in the industry for the last 25 years, you've been there, done that, I'm sure you have a lot of perspective on customer experience, and I'll hit the point there first. Customer is centric to anything that anybody does. That's the most important part of the business. And in lending, servicing the customer and essentially servicing them right so that there is a great experience is very important. But with co-lending, there are two partners servicing one customer, Brajesh. So, and also there is a report by McKinsey that says that 45% of the borrowers drop off due to a bad loan processing experience. So I want to ask your perspective on how this can be improved, and with two partners being involved, how an experience for a borrower can be made much better in co-lending.
That's a very interesting question, Rahul. I think that study of McKinsey you just talked about shows a very, very challenging situation. And it's a very crucial challenge to solve. Now, it has to be addressed with a holistic approach or a comprehensive approach at variety of stages in a typical loan application journey. First, I think we need to look at the customer onboarding itself. It is always essential, to have an end-to-end customer onboarding process with the API-first approach. As you can see that most of the lending tie-ups, there is no unified or a co-branded single application form. Lender 1 will collect one certain set of data, lender 2 expect another set of data. So that's where the first friction starts. Okay, so that has to be fixed. Secondly, if you see, is with regards to the the data points I just talked about, is on the the customer acquisition front, and on the KYC front. As you see, one lender collects certain information on the KYC, the other lender also expect to do the same. So that's also, there is a bit of a repetition. Okay. So all these touch points basically adds to some bit of a friction at the customer end. Second point, when we move to the the loan processing side or at the underwriting side, that's where most of the the friction takes place. Now, what happens is that while the credit policy of lender 1 and lender 2, aligns well at a paper level, okay, but when it comes to the BRE level or at a system level, they falls apart. A typical customer application gets approved through the lender 1 BRE, and it gets rejected on the other hand. So that itself is a big friction issue. That needs to be fixed. And also, if you see, if a particular customer has stopped or paused his particular application due to some reason, and if he wants to resume it as a returning user, he has to start all over again with both the lenders. So I'm sure it is a very, very irritating experience for any customer to start all over again. So obviously, any returning user, there has to be a pre-filled information. Okay. Third stage is, of course, when comes the loan disbursement stage. To remove the friction there. We have seen there are lending regulation directs lender one to disburse the loan first, followed by the lender two post the confirmation of the lender one. So there is a sequential loan disbursement. So obviously, unless and until it is API driven, okay, and unless and until there is a digital process which takes place, so this also delays the disbursement big time. And also, at most of the time, what happens is that we choose very conventional auto repayment mode. So nowadays the UPI-based repayment modes are available. So one can always choose to kind of quicken this entire process. Lastly, it comes to the live loan status tracking, okay, and and keeping the customer transparently communicated about the status of the loan. There is an essential requirement of having an omni-channel support system in place, and these channels include your WhatsApp, your chatbots, your mails, as well as the calls. So in the absence of this omni-channel, so there is a lack of always a lack of live status updates, so which obviously puts the customer off. He doesn't even know what's happening to his particular loan application. And last but most important thing is that our web application interfaces, whether it is on the mobile or on the web, is basically so bulky, and it creates a lot of technical glitches, especially for the customers staying in the hinterlands or in a low connectivity areas. They can't even move to the next step because the application itself is not loading. So as a responsible lending companies, we need to develop very light touch and highly vernacular interfaces, which actually enables our customer to consume the application while staying in the hinterlands or in the low connectivity areas.
Great points. What I really liked about what you said is that there are multiple touch points in our customer's journey, and there should be omni-channel approach where you allow the customer to pick up from wherever he's left. And you also mentioned that two different lenders have two different kinds of forms. So coming to a question to Atul, when you are in the space as a fintech, but you're working for secured loans. And secured loans are a different devil altogether, because unsecured loan, there are lesser data points to collect. Secured loan, there are more data points to collect. You may have a different process of onboarding and collecting data, and the bank would have a different process. Do you think streamlining this at an industry level will help increase efficiency in lending, or can there be a standardization in the co-lending process?
Sure. See, it's a typical debate of standardization versus customization. Obviously, with standardization, you have more efficiency coming in, but and that will reduce your cost. But there are areas where you need to have customization. I'll give you with real example. When we started as a broker, as you rightly pointed out, we have more than 100 banks on our platform and HFCs. Now everyone has their different process. Now if we have to build a digital journey, if we take their APIs, one API takes around 3 to 4 months or 6 months to get integrated. So you can say it's around 600 months of workflow. So what we did was we created something at our end, that we created 3 boxes. One is a a status box. So we asked all the lenders to just provide us a single API from their end, where we can fetch the the status of the application we have sent. On top of it, we had a second box where we can just pass on the basic details of the customer, that is name, email ID, phone number. And third box was documentation box, where we fetch the document from the India Sec and all. So now we have standardized the APIs for all the lenders, that we don't have to build a new journeys on our platform or new custom UIs for different lenders. So their standardization helped. But as we move more into our FLDG model, so there we need to do the credit also. And in India, especially in home loans, properties are varied. Means if you see in Gurgaon, you will find registry properties, Gram Panchayat properties. If you go to Bangalore, it will be Khata A, Khata B. So you need that kind of customization. So there we asked the lender, where we have these partnerships, that you give us right, that we do it at our system and we'll just pass on the final response to you. So that we can, actually cater to diverse needs of the customers. Customers are different, properties are different. So in short, I'll say that yes, standardization is important. So do is customization. So we need to take a hybrid approach, that where you think things are standard, as in doing KYC, creating a lead, sending information from one system to another, you can have an API based approach. But where you think you have to cater to diverse set of your requirements, you will need customization. You will have to live with a hybrid model. Till that time, at least you don't have standardization in properties, at least in the housing sector, I can say. Both will be required. You cannot say just we have to standardize everything. So so that's my point of view, that hybrid should be the approach for both the things.
Rightly said, standardization also kills innovation in a way. And the existence of a fintech LSP in a way is to be able to get to do that work which a bank can't do. And the agility that you bring to the table, it definitely adds a lot of value to the partners that you're working with.
Yeah, to some extent, yes. But yes, standardization also helps you to innovate further. See, as I told you that, now we have standard, procedures with all the banks, that we can send them the application, we can send them the documents, and we can collect the status from them. So now these things are standardized. So you can think of building something more. So that's why we thought of, doing credit. That, okay, now, brokerage business is set. It's going through the thing. Let's take some more, work streams from the bank, that let's do credit also, let's evaluate property also. So standardization at least makes sure that a part of your business is, is you don't have to monitor it that much. It's you have dashboards to see that, and then you can keep on innovating more things. So that's my point of view, I'll say.
I think well taken. So with what you said is that standardization has to come, and I think standardization from also a regulatory perspective. And with this, I would like to get Vasudha into the conversation. Vasudha, since you understand a lot about internal risk assessment and audit, what is your outlook when Atul talks about standardization in processes and co-lending being the newer concept for banks? Do you think more regulatory standardization, or what is the outlook for regulatory changes that the government will bring in the next couple of years to make co-lending essentially the go-to model for any lender, or the primary model of lending?
Yeah, so see, what we need to understand is that even though the co-lending has been in existence since long, but it has not really scaled up to an extent it was expected. November 2020 also, when the guidelines or the FAQs came up, even since then it has not really scaled up. And I think between NBFCs and banks, the model of DA or securitization, that's still more prevalent than co-lending, because co-lending is basically coexistence. And coexistence is wherein, everybody has to, be on the equal platform and be willing to shell in more of their responsibilities than thinking that, okay, I can take a back seat and let the NBFCs do their job. So when it comes to regulator, I think the expectation from an NBFC perspective would be that there is this minimum 20% of the risk bearing by the NBFCs. So when the NBFC is eligible for the co-lending model, eligible in the sense that it's a regulated entity and the bank has done its due diligence and all, and the bank wants to go ahead, then the RBI should not bind us by saying, okay, 20% of the risk has to be borne by the NBFC. Why can't it be 15? Why can't it be 10%? Give me that flexibility to have lesser risk. Point number two is that, it's about the requirement of the banks in terms of their PSL norms, that, this co-lending piece is existing. So while they have these targets for the PSL, 40% and all, but they really do not have target for PSL through co-lending. So I think if regulator mandates that, okay, this much of PSL has to be through co-lending, I think we'll see it scaling up. And then in terms of disputes between bank and NBFCs and all, like we have grievance redressal for the clients, maybe we can have a dispute redressal mechanism between the lender and the NBFC. So I think, those can be some of the regulatory interventions which would help it scale it up. But ultimately, then yes, it depends upon the tandem between the NBFC and the lender, how much they see themselves to be, in the game, that it will thrive.
Great points. I think one thing I would like you to touch base upon also is the understanding of compliance between the two lenders. There is a lot of gray area, especially regarding reporting, asset classification, and how do you report those assets. Also, banks or larger lenders insisting on take back of bad loans. Do you think there will be further regulations that will make it very clear for the NBFCs also to work in this framework and not take decisions based on the business compulsions in a way?
No, so no NBFC would take decisions based on business compulsions. I mean, I think only because NBFC has entered into a co-lending model and it will become, it will get little easy on its processes. It doesn't happen that way. In fact, it happens vice versa, that when you have a partner in that to a bank, which is a much bigger an entity, there comes a lot of responsibility also, which we as NBFCs understand. So we don't get easy on our processes, really. And I think banks also, since I come from a bank before NBFC, I think banks have to understand that NBFCs cannot really be as process-oriented as a bank is. SBI or any other bank. We can't really be banks, as we were discussing pre-session. So banks also have to understand that NBFCs, they have to set their expectations right, and I think the banks have to tweak their expectations a little more than NBFCs have to sort of prove themselves that, okay, we are in the game for long.
I think good point on that. Just picking on to what you just said, the difference of a bank in terms of regulation and an NBFC of a regulation, I think I'll take it to Sanjay now and ask you a question, Sanjay. The risk appetite of a fintech, an NBFC and a bank are three very different structures. So how does this fundamental de-alignment in terms of risk appetite affect co-lending? Because you as a lender and as an NBFC will have a more I would say more robust approach to risk assessment, and you would want to take risk in certain areas to try innovate some products, but that would not be the reciprocation from the other side. So what does an NBFC need to do, and how does it need to work with a partner on the other side?
Sure. I'd suggest this is most interesting question of the as of now to the from the panelists. We need to understand three basic layer points here. The risk assessment, the risk awareness, what we talk about these terms is largely driven by three main core regulatory guidelines of the RBI. One is, while onboarding any customer, how you onboard the customer, there should be a true assessment with respect to the customers very well. That respect to understanding the KYC compliance, KYC guidelines, that's a one core important piece. Second is, while onboarding, there should be no dilution or no delegation of authorities in terms of underwriting and the product pricing policy matters. Third, which is very largely, is the fair communications and the transparency with respect to the customers in terms of where they are getting loan and everything. Now I tell you, for all these three parameters and the different three partners which operate in the industry, let it be fintech, NBFCs and banks, have different degree of optimization in these three, each of the layer. For example, if I talk about KYC part, as of today, let it be any fintech or NBFC, all are well versed that there are a lot of tools and a lot of deliveries has been arrived in the market which help you to underwrite the customer more diligently than just a physical OSV papers, because that could be forged, that could be typically managed out, but various utilities from you could say NSDL, PEN 360 APIs, or you could partner with, let's say, Hyperverge and SignZ for sharing those, know you the customers. For example, if I talk about 3 years back, only way to optimize the Udyam in case of MSME customers was largely through UAP platform. But now the ODM APIs are also getting generated from ScienceE and the Hypervisor, right? So they have advanced themselves to such a very high level that it helps the NBFC, fintechs, and banks both to not only onboard the customer in terms of so-called KYC, but also the compliance document in terms of understanding the customer as well. That has been, I would say, more of 80 to 100% of adoption from all these three partners. Second, I would say coming on the pricing and underwriting the customer, the black box on the BRE. Only fintech is the one, and the NBFCs who are fintech focused, they are the one who can design and understood and have been deployed this as a very largely as a black box. The BRE with respect to the writing various variables through the AI data, right? Using the lot of data analysts from the Digi data, bureau data, and other surrogates. However, the mindset of very traditional NBFCs, which are AAA category, are getting into focus into this. And thirdly, banks are not even keen to adopt this as a method of as of today. So that is playing a very difficult role now. They are not keen because they have come with a mindset, with a traditional mindset, that while assessment, that means we have to meet the customer, we have to see the cash flows, we have to see the bank statements. The digital adoptions of all this is yet to be adopted by these players. If you see the other way out, the technologically adoption by these two partners is such a that they can bring a funnel for your customers in a very huge base. But these people lack of capital. Capital is sitting at with three banks, right? Large banks. If they have a mindset with the RBI guidelines where, let's say, if I take an example, for example, Finbox. I am not sure how many of your heads use the Finbox. We are typically started using Finbox now because that has helped us to eliminate the various manual processes involved, because that Finbox what do? It helps us to understand the customer coming in the funnel, help you to underwrite which customer will help the BRE for different co-lending partners. For example, you have a 10 co-lending partners. One co-lending partner says, I would want a customer with a 700 CIBIL score plus, maybe from geography only from Maharashtra and let's say Delhi. Third partner will say, I need customer with 650 plus CIBIL, with an AQB of 50,000, only sell right, only self-employed. Now all this decoding and the writing of logics become very efficient when you have aggregator in place, which help you to allocate the funnel automatically to each lender without shaking the hands. So that becomes a core adoption nowadays from the fintech and the NBFC's point of view. But this is yet to be adopted by the large banks. So this is very growing aggressively on the market nowadays from the co-lending perspective. This is helping us, if I talk about, today we used to disburse on book, if I talk about with a digital journey of 3 to 4 minutes, we do the same journey on the off book as well. And not only with the smallest NBFC, but with the largest NBFC as well, like SMFG is the one of our core partner. Piramal is our core partner, right? So so these large NBFCs also started adopting those variables and the tech integrations point of view, yet to be adopted by the banks. Third, communication. Now this is also become a robust from the internal governance point of view. Fintech, I would say, still have not done good job of it. They have done good job of it sourcing the lead, but bringing the transparency, bringing the communication with respect to the who is your lender, what is your APRs, what is your interest rates, who is your co-lending partners. Because for the customer, the RBI is very clear. If you are doing co-lending, the customer should be aware that there are two partners have funded you, and there is a two proportionate, and there is two different commercials, and there is a two different pricing for you. Now fintech is not done the very good job of it, but the fintech-led NBFCs started adopting it because the DLG guidelines has come very recently in November 2024, right? That has helped us to publish KFS and everything, right? So I would say now this is actually adopted in the third level again very diligently, but not at RBI. But bringing bank and NBFCs and the fintech at the same level, it will take time. I would say maybe when they have a clear mindset with respect to the assessment of the underwriting, when they think that delegation through, I would say through black box BRE, where they have a internal BRE in place, internal API in place, if they trust their own and they design it, I think that will help a lot to grow very effectively in this case.
Well said. I think you've given a clear guidelines of what happens at a fintech and what happens at an NBFC and the challenge. And one point I have picked up in this one, you rightly said that you're able to work with larger NBFCs better, not banks. We'll come back to that thing, but I think we like to also have Rohit on the panel.
Yes,
Rohit.
absolutely. And he has joined us now. So I would like to invite Mr. Rohit Mehta, MD of Akasa Finance. Please give him a huge round of applause. And you may continue the session.
Right, so since Rohit is here now, I think we'll take some opening comments from Rohit. Rohit, how do you, we've spoken about regulation, we've spoken about integration between banks and NBFCs and fintechs, but we want to get your perspective on where do you think co-lending and the impact of co-lending as a primary model for lending, and how do you see this growing in the next couple of years, especially with these kind of segment that you are into the EV financing segment? You can throw some light there, and also about the data sharing mechanism between yourself and the lender that you're working with.
So first of all, apologies for being late. And co-lending, so what we do is we basically finance electric vehicles, specifically rickshaws. That's a very niche segment. Now this segment is too small for any bank or larger NBFC to get into. It just does not make sense for them because the market size itself is not big enough for it to be a very serious focus point for them. But this is something that they would like to do. And that is where co-lending comes into play, because you have smaller NBFCs or smaller players who are very good at what they are doing. They have their own niche, they have their own experience, they have their own way of doing things in the market, which is more operational in nature. And banks through them can get into their books the kind of portfolio that they would want to have. So suppose green funding or electric mobility or green mobility funding that they would like. But doing it directly for them would not be possible because their OPEX would not be sustainable for these kind of small loans or the kind of operational field bandwidth that is required. That is one of the primary reasons why co-lending is being developed as a model, because you see a lot of small niches. So unsecured loan is one of them, electric vehicles is one of them, B2B funding for your delivery bikes is one of them. So there are a lot many examples where it does not make sense for a bank or a large NBFC to go down to the ground directly, but find a partner who is able to do it, keep their processes and their rules and regulations into mind, and pass on the information while being compliant to the parent. So when these setups are in place, and in today's world you have technology, you have APIs where you can have a seamless transaction of data from the child to the parent. And with that happening, it has become much easier now to manage all the accounting, all the ledgers, all the KYCs and all the other compliances that are required than it was before. So we will see in the future co-lending will become a very large portion of the market for new segments that are coming in.
Fantastic and good analogy of a child and a parent. Coming to Vasudha, I think we had a very similar discussion on the approach. You said that, the lenders such as, NBFCs essentially who are working in the tier 3, tier 4, 5, 6 towns have a very different approach to lending to the customer and the kind of customers they want to acquire, whereas the banks do not have the kind of infrastructure, I would say, the intent to actually go there. And you mentioned that there should be a regulation on the PSL portfolio as well within the co-lending. So I want to pick up from that conversation we had, and I think you could share it with the audience as well. How do you think and why do you think co-lending is not just important from an NBFC side, but also from a bank side?
So, by the sheer size of the bank may think that, okay, we are the ones who are sort of funding and then putting on all the responsibility in terms of the due diligence of the client. And see, the ex-ante due diligence is only really on paper because it's ultimately the NBFC or the I would say the originator of the loan who's doing all the due diligence. Banks, they come into picture much later once the due diligence has been done. So I think yes, and the expectation is a lot in terms of PSL lending or the regulatory reportings to be done by the NBFCs only. So I think when the NBFC is doing all the groundwork. We know we have the reach. We understand the clientele. We understand how without any, I would say, without any structured form of underwriting or understanding the income expense of the clients, we are still able to do the credit appraisal and sort of filtering out whom to be given the loan. I think over there, then the bank should take a backseat and leave it for us. I mean, to the experts, because we are the expert in that field, and I think bank can trust us to that much at least.
Right, let's say leave the work to the experts, and then trust on the partner. I think as it's a partnership, trust is very important. And since I in the initial comments I made that Brajesh is just starting up a co-lending journey of your own, Brajesh. Couple of thoughts on the journey, how it has been, and what do you think is the preparation required for this partnership to be fruitful? I know that you've already mentioned that tech and processes are important, but your thoughts on how this partnership can be a success for both.
A very important question again. I think for any co-lending partnership to thrive, it has to be fair, flexible, and built for long haul. And we can only achieve it if we have these 4 elements as a pillar, right? First, risk. Second, reward. Third is cost. And fourth, most importantly, is the losses. Okay. So let's first understand the risk. So there can be a risk-based revenue mechanism. So the entity which takes more risk should also get the more revenue. It's plain and simple. So by virtue of that, the larger banks and NBFCs obviously take larger exposure. So hence they retain the larger share of the, the interest income, so to say. Similarly, the smaller NBFCs and fintechs plays a vital role in terms of origination, sourcing, processing, as well as the collection part of it. Hence, they retain the larger share on the processing fee side as well as on the other, processing in the sense charges they collect. Then comes is the, the performance-based incentive. Now, the partner who does or demonstrate a higher efficiency, both in terms of the collections, quality, as well as maybe a cross-sell income, they should be obviously given 1 to 2% extra incentive in terms of the repayments, what they collect, or the cross-sell income they generate. Okay. Third is the fair allocation on the costs part. And to avoid potential conflict, I think it is very, very crucial to be very clear that who's doing what. Like for an example, the smaller NBFC stroke fintech, they by and large does the origination, processing, underwriting, and the collection bit. So obviously the cost attached to it, they are the one who bears that. The larger NBFC stroke banks, obviously, they provide very low cost capital. So hence they are the one responsible to bring in that capital, and they retain, a portion of the interest income, while the smaller NBFCs and fintechs retains the, the interest income over and above the hurdle rate which has been agreed upon. Last but never the least is the losses. Okay, so that's where, this is the crux of the whole situation comes in. Now there are obviously some RBI compliant structures available, like RBI says 5% FLDG, and if any smaller NBFC or a fintech agrees for a FLDG part, say for an example 5% FLDG, then any loss over and above this, should be tiered and should be shared on a proportional basis, rather than, though it's easier said than done, being a smaller NBFC myself, we don't have much choice, and we have been ring fenced or have been forced to say anything and everything which goes bad, over and above even the FLDG part. But ideal structure should be that if it is, if I'm giving FLDG, over and above the loss should be suitably proportionately shared. I think that's what I should say should be a fair framework.
And what you're trying to say is that since you have different bargaining powers in a partnership, you tend to go beyond and also to look at the future business, because you just don't want to look at what you're going to do today, but also a future partnership with the particular bank, etc. So I have one question. I'd pose it to both Atul and Sanjay. See, co-lending with one partner, may not work, but co-lending with multiple partners is what you guys are doing. How do you essentially decide which partner to work with? Is it tech-driven? Is it business-driven? Or in case it is tech-driven, how are the BREs built up? How do you incorporate multiple BREs into one single BRE that you guys would want to run?
See, the co-lending, when we do with different partners, it is for different needs. So we create different products with them. Obviously, the purpose of BRE is to segregate. We use the BRE for that, and hopefully in future, there will be AI incorporated to that, because BRE can only tell you, the difference based on some standard set of rules, but AI can even tell you deviations. That's what people are building on. So yes, we have a BRE to segregate the requirements of the customer, and generally, at least in basic, we don't do that we do same product with different lenders. We try to incorporate different products with different lenders, because every lender has their their own risk appetite. Like if we have a FLDG with DMI, so we want to do more lending on the cash income side. And then if we want to do lending on the salary side, I have that with Tata. So we try to segregate our lending partners also based on the product requirements, and then BRE is able to segregate it easily.
Thanks, Amit. So largely what we have been in business so far and what we drive the principles for the co-lending is that we are the NBFC which has generated 11 million unique customers so far. And our objective is to co-lend is that how to cross-sell these customers with a higher ticket size, with a higher cap table on the partner, but not at the cost of customer convenience, because that's become our core part of the whole thesis of the business. So for us to choose a partner, we broadly, first alignment is that we should have a tech alignment on the part of not only from sourcing, but from the monitoring perspective as well. So maybe a partner with, let's say, 1 lakh market capital and let's say 80,000 AUM, but with no digital lending, we may not be an interested partner with them, because that it goes for a toss, because my customer is in the waiting zone for 2 to 3 days. So that is first and foremost. Underwriting policy for us become the secondary, but first is take. Because if there is no handshake on the take, we won't be able to create the same flavor of convenience for the customer, which what we are creating impact on the customer. Second, it becomes very important for us to sustain the relationship. See, it's easy to build the partnerships, but more important is to sustain those relationships. Now, this relationship, these people are come up with let's say, with the tech, but the mindset is they are fully backing on you, right? They are completely backing the whole capital on you. So the second foremost important is how and effective underwriting controls you are playing for the customers who should not cross the buckets which they have been agreed through the co-lending policy, right? If we do that, then partnerships go for a toss, they will shut the business. Then to revive this business, you will hold for 6 months, and the whole your sourcing cost, your tech cost will go on for a toss, right? So second important factor becomes is that any partner who is coming on the board, we try to understand how they're coming on with respect to the not only in terms of the BRE, but more importantly, the vintage of the business. The vintage should be very important, not only for 6 months to 12 months, the vintage should be for at least 2 to 3 years period. Thirdly, which is very important, the partner should understand the very important factor which Brajesh laid down is the risk and reward, right? Because we are coming with a platform where we are managing all the processes and all the operations excellency for you guys, right? So the pricing become a very important factor for us to reward it, because these large NBFC comes with a lower cost of capital and we comes with a higher cost of capital. So the margin is become a very important play for us to bring the table on the partner. If I'm getting the same partner, the same cost of capital which I'm raising the, let's say, other way out, the traditional debt, then it's not feasible for me to get this partner on board. That partner should help me to provide the that risk and reward in some form and shape. Let's say I'm raising 10 odd as a cost of funds, then this co-lending should be 8 cost of funds, because that 2 delta become a margin for me to deliver those excellency for him. So these are the 3 fundamental pillars which we follow internally for partnering any co-lending partner.
And I think also you speak from experience. What I've heard again, very interesting from you, said that you also look at the legacy of the other partner, at least 3 years so that they understand your business. And I think that's a way around for different customers where different NBFCs where the lending partner will ask for legacy on this side. So I think that's a great perspective that you bring in, that once you go into the business and you have leverage on your side, you need to execute it. And also one thing that you said is co-lending partnerships definitely happen between partners who can sync up their tech. Otherwise, it is always on paper and there's a good photo, but nothing moves for the next 6 months. But I don't know, if any of the panelists wants to add anything to co-lending or their perspective on tech partnerships, any one of you all?
Yeah, I think one important point which I miss talking is the regulatory compliance part of it. It's very, very critical. I think we should have that in mind, because as you know that RBI every day, there is some or the other, regulatory overhangs are in place. So it is very important for both the sides, lender 1, 2 or even 3, to make sure that from a regulatory compliance perspective, we have taken all the necessary steps to make sure the relationship becomes much more sustainable.
Regulation first.
I also want to add to it that the lender has to be a little patient, I would say, for the partnership to work, to give it at least a year's time, if not more. I mean, it can't really be the way the internal targets in a bank's function, that okay, how much you have got, and every month there's a review happening, or every quarter it is happening. Give it at least a year's time, if not more, to gauge whether this partnership would really work or not. So yeah, so my take is that give co-lending some time for it to flourish.
Well taken. Atul, Rohit, any closing comments you guys want to make? And we'll take a couple of questions from the audience. If somebody has any question, please do raise your hand and we'll try and send the microphone to your seat.
See, I actually wanted to add one point on the PSL discussions which we were having. See, I think the requirement of PSL primarily comes from the fact that most of the PSL lending happens in informal segment. If you see housing loans also, or you see education loans or other loans also. So most of the banks don't have their cost to income ratios to support that kind of lending. Means the cost of building branches in those places, running that actually removes all the profitability which they're building. So their co-lending becomes a necessity, because a local player will know the industry in that area better and will be able to provide much better customer base to that bank. So PSL will actually be more effective for the bank, and it's a mandatory thing they have to do. So co-lending is actually good for making PSL books for the bank, I'll say.
Any questions from the audience? I see a hand up there. Can you please pass on the microphone?
Hi, I'm Aman. My question is to all the panelists. Do you think co-lending will make home loan process more instant? One. And second, what are the apparent risks that come with it?
Who would want to take this one? I think home loans.
Sure. See, in home loan, if you see, most of the lenders, typical HFCs or banks, their processes have been very traditional. Means obviously from past few years, a lot of digitization has started happening. Now, but it becomes very difficult for a lender to implement those kind of technologies immediately across the branches or across the workflows they have. So co-lending actually gives them an easy entry, by leveraging the tech platform of a new player to at least gauge new workflows, at least test new workflows, and then implement it across their own operations. So definitely co-lending will help the lenders in promoting more digitization at their end, and that eventually will benefit them in future.
I want to add to that. So see, a product like home loan is where the co-lending can come in place in the true sense. So co-lending is basically what, okay, I am chipping in 20, you chip in 80, and the amount which is going to the client is basically going from the books of both the NBFC and the bank. So it really cannot be in a quick loan like a PL or a 10-second sort of a loan, wherein on a real-time basis, the funds are coming in from two different entities. But typically a home loan wherein there is a gestation between the lead generation and the conversion, or the sanction and the disbursal, I think co-lending would thrive in a business model like housing loan. Yeah.
My views are a little bit different from my panelist. I don't think home loan is a segment where co-lending would be a very big thing. One, the margins are very low for it to be shared across different players. Second, the ticket size is very large, so it does make sense for a bank to actually go and have a ticket size which is a large amount. The tenure is very large, so you are not looking for normal partnerships which go across 5, 7 years, 10 years. So normal co-lending partnerships are short duration products, 2 years, 3 years products, where if you want to exit, you can have a quick exit. You don't want an exit which will last 10 years, 15 years into the future. And fourth, even if there is a co-lending, then the bank or the larger NBFCs may be trying to test the waters, that let them take the risk, let us understand what the product is, and then if it is suitable and if it is profitable, we'll get into it ourselves. So home loan does not, for me personally, seem like a segment which would have a very large co-lending base.
Unless you do a direct assignment.
Unless there is a direct assignment. It won't be a co-lending model. It would more be a securitization.
It may start with a CLM2 kind of a thing. Yeah. And then you pass it on. See, my view is co-lending becomes successful. The backbone of the co-lending, I think, is the digital, having the digital disruption play in that. Unless and until you have a technology in place, co-lending doesn't make sense from a process perspective. Obviously, from a small NBFC or a small lending company to a large lending company, it solves the capital problem for sure. But the key to its success is that you have to have a technology play in place. Imagine a situation, a home loan application gets processed manually first by lender 1 and then by lender 2. Unless and until there is a technology overplay in that, it's not possible, it's not feasible, because it will add to a lot of TAT and hence becomes, almost, impossible to kind of take off. So unless and until you have a technology at the core, I don't think so this model can take off.
Just adding to what all other panelists had said it, what I feel personally being into 8 years of co-lending business, what I feel that the co-lending has seen uptake for each asset class differently. For example, unsecured, if there is a PL or BL, has been significantly uptake from the where it was. But for the secured asset class, it could be any secured asset class. More than one is important technologically. Second is relevance of in India. We have no digitization also in terms of the charge creation, Sarsai creation, title deeds creation, right? That becomes a core hypothecation part, which is very risk-centric from the large banks to adopt that. Maybe I am wrong today, but I believe in future, maybe 10 years down the line, when RERA will be fully in place, when RERA would comes with a fully digital adoption of title deeds in the records and the RERA, and there will be some players in the markets who are building a tech which bringing the markers and the variables from the RERA and the municipality records, where they will be sharing you a lot of the hypothecation, because in this segment it's very important to create, specifically in LAP, right? It's very important to create the clearance on 13 years title search, which is very important factor in today from the Indian market perspective. So that could be only bring when there is a digital signals coming from either from the any account aggregators or any when the RERA would be having a full-fledged adoption by the whole Indian economy completely, by the each real estate builders, then it will be playing a very different role. But saying it, co-lending, yes, today also co-lending in home loan is happening through CLM2 and direct assignment is also happening. There is no to that, right? That's still happening. People are there, like for example, large banks still doing it because they are not 60% business through organic and 40% is inorganic. And inorganic also there is 12% is through direct assignment, 18% is through PTC routes, and remaining through the co-lending routes. So that's what they are still doing it, and they will be keep doing in the future also. But I would say that will come only from the when other account aggregators and the variables comes into place.
It was great to understand from an organizational ecosystem perspective, but from a consumer perspective, my question was actually, does it really benefit them to have a co-lending kind of a deal or a direct lender deal?
I would say yes, completely yes. Because when you partner with likely I said, right? If I am a mid-layer NBFC where my cost of fund is let's say 10 odd, so I'll be funding at 12. Now if I partner with a large bank where their cost of fund is MCLR is 6.5 and 7. So with a backbone of 80% coming SBI in my platform, I'll be sharing the same customer with a pricing of 8 and 8.5%. Second, he also get privilege that he is not only backed by the one of the mid-layer NBFC, but also supported by the top layer bank and the combination of mid-layer NBFC, where the processes are handled by the mid-layer NBFC, but the funding is coming from the top loss. So he is also very much confident that if there is any something title deeds which is giving as a guarantee to you back, right, as a documents, because that becomes an emotion for him, right? In India, even for the gold loan, which is to be hypothecated, it becomes emotion. They are coming with tears, right? I have to hypothecate you. So what if that the bank or the middle layer NBFC wipe off, right? How would I get my documents or my property back? So that will becomes a very important convincing factor for the customer as well in that perspective. That's my thoughts.
I think we've covered the, I hope we've covered the topic in detail, and I think what you're writing to say is that if the benefits of co-lending are actually passed to the borrower, the partnership benefits in terms of interest rate, in terms of serviceability, in terms of being more customer-centric, definitely it would help even in the HL space. So I think with this, our time is up. I hope the audience was able to gather the extent of the conversation we've had, right from secured to unsecured loans, the requirement of a co-lender partnership from an NBFC and from a bank perspective as well. I'd like to thank Vasudha, Atul, Rohit, Brajesh, Sanjay for the excellent conversation we've had, and obviously for B2B Infomedia. Thank you guys for inviting us, and we look forward to the next sessions. The day is still yet to complete. We've got one more panel coming up. Thank you. Thank you for the audience for being wonderful and listening in to us.
Thank you so much. I would request all of you to please come forward for a group photograph. Please wait for a second, and I would request all of you to wait for the memento session. I would request Mr. Rahul to please come forward and present the mementos. You can just proceed. And please, when we are doing this, can I have a huge round of applause so that even your energy levels are moderate. Also, I would like to call upon Mr. Vaibhav Kumar to present the mementos. Thank you so much, everyone. I think that was a very fruitful session. A group picture also, please. Don't forget your photographs, of course. These are the moments you'll recall later.